All right, so this is chapter 16. Try not to fall asleep, although it's possible I will bore you all to death, because that's how I roll. And chapter 16 covers what's called job order costing. And we'll talk about what that means here in a minute. I'm actually gonna turn my camera off, I think. There's no reason to have it on. All right, so job order costing. So let me just kind of give you a sense of what we're going to cover in this chapter. I always skip these learning objectives, but all of the training we receive is that telling people the learning objectives up front and giving them a little bit of a frame or overview for what we're going to cover supposedly helps their learning. I think my problem as a student, I always thought these things were like lame. So I was like, just get to the stuff. But I also noticed on my teacher evaluations from last semester that like 3 or 4 people were like, he goes through stuff too fast. So I'm like, I gotta try to figure out how to slow that down. That's my fault, I guess. So our learning objectives is we're going to learn about cost accounting systems. And then more especially today, we're going to learn about what's called job order costing, which is one type of accounting system that manufacturing businesses use. And then, well, that's primarily it. So these all, because all 3 of those others are about different parts of the job order costing system. So the first thing is, when we talk about cost accounting systems, what we're trying to do is just say, what are our costs? And we want to figure out ways to measure our costs, okay? And you would think that there would only be one way to do that, but there's multiple ways. The 2 main ways that people do this in managerial accounting are what's called a job order costing system and a process costing system. In a job order system, which is usually used for businesses who do special orders, like they don't build stuff until they get an order from somebody. And this could be anything from like a furniture company or construction companies that are building a house for someone. What they do is they measure their costs by the job or by the order, okay? So it's not that you're doing it in job order, it's job/order costing system. It's either by the job or by the order, okay? As opposed to companies that do like where they make a whole bunch of the same like stuff, like let's say a Coca-Cola bottling company or something, where they're making huge numbers of bottles and filling them with the same mixture of syrup and carbonated water and then putting a lid on it. It doesn't make sense for them to somehow try to separate that into separate jobs. It makes more sense for them to track their costs by each of the processes. Maybe process number 1 is cleaning the, sterilizing the bottles. Process number 2 is this mixing department where they mix the syrup they get from Coca-Cola with the carbonated water. Process 3 is filling the bottles. Process 4 is packaging them for delivery or something like that. Or I don't know. So one focuses on jobs or orders, the other focuses on the processes of it. Okay, so today we're going to do job order costing systems. All right, so the reason we need to really have a good handle on what things cost is because we need that to set the prices. You would be amazed. I mean, it's mind-boggling how often when I'm doing consulting that I'll go into a business and they'll be like, you'll say, well, what price are you selling this for? And they'll give you a price. And then you'll say, what's your cost per unit? And they'll be like, we don't really know. And I'm like, well, how do you know if you're making money or losing money? Right? Like they don't know. So you need to know the price or the cost of things so you can set prices. You also need to know the cost of things so you can control operations. So you can say, is what we're doing what we plan to do? If you don't know what it's costing you, it's really hard to do any real controlling. And then finally, to develop your financial statements, you have to have a good understanding of what the costs are. And so, like I said, these next 2 chapters are about a couple different types of costing systems. All right, so this was this company we talked about in the last chapter, Legend Guitars. And we know that they have 3 different types of inventory accounts. a materials inventory account. Sometimes some companies call it raw materials, stuff that they're going to use to build their product. Work in process inventory accounts. Those are things that are being built. And then finally, finished goods inventory account, which are things that are built and now ready to be shipped out to the customers. We know that their direct materials and part of their direct labor are going to be what we call prime costs. This is just a review of terms from last chapter, okay? And then direct labor, a portion of the direct labor, and the factory overhead are going to be put into what are called conversion costs. We know that factory overhead are all those things we can't exactly figure out what the cost of is going to any one item. That would include things like depreciation on the factory, supplies like glue and sandpaper, utilities, supervisory salaries. That's what factory overhead is. And we start with materials. Then we take the labor, the cost of the labor, and put that into the cost of the materials. That gives us the cost of our work in process. And then when we finish it, all of those costs rolled together are the cost of the finished goods. Okay, so that's a review, I think, of chapter 15. If you haven't done it yet, the chapter 15 homework is due tonight by midnight. You guys have worked with me enough to know if you needed till tomorrow or something, not a big deal, but really better off to just get it done by its due date. That will keep you on track, right? Like, don't get behind unless it's an emergency. And don't think playing pickleball constitutes an emergency. It's fun. And you guys play pickleball? Seems like it's a thing that's all the rage nowadays. I played it like twice with my kids, and I seriously got like tennis elbow, and like it's hurting like months later. This is what getting old. It's BS. Okay, I'm just gonna let you know. Things that you shook off in a day as a kid, a month later, you're still like, man, that pickleball. Some people say length and height is a disadvantage in pickleball. I disagree. Reach helps you in that game. I mean, unless you're taller and you lose speed because of it. But I think if you could be tall and fast, that would be an asset. All right. If you haven't tried it, give it a shot. It's pretty fun. I call it slow tennis. It's like tennis for people who aren't fast. All right. All right. So here's our flow of manufacturing costs. Again, kind of review. We have our materials from the material storeroom. They flow into the production process where we're adding, that's not even a word. We're adding labor and factory overhead costs into the cost of our materials. And then our finished goods go to the warehouse. And now the cost of these finished goods have all of this material and labor and overhead kind of added into it. And then we take it from there to the music store, and then it becomes a cost of goods sold when we sell it. Okay, so that's the flow of costs. Remember, our balance sheet will have multiple types of assets. We'll have multiple types of inventory assets. We'll have materials or raw materials. We'll have work in process inventory, and we'll have finished goods inventory. And then when we sell the finished goods, the cost of the finished goods we sell becomes the expense cost of goods sold. Woo, okay, this is a busy slide. So this kind of shows us this process, okay? What we have, this is a materials ledger account. So what happens is when the business buys from the supplier, so right here we have a supplier invoice, we buy some materials, $10,500 from the supplier. What we do is we add that to the supplies account. And if you think about the journal entry for that, we would be debiting the supplies account because it's an asset account for $10,500. And if we paid cash, we'd be crediting cash. Okay. Or if we didn't pay cash, then we'd be crediting accounts payable. Right. So you can see the balance. They had $2,000 in the account. Now they added 10,500. Anyway, so this is this whole process. Then the people who work in the on the production floor, when they come and they get the materials they need to make what they're making, we're going to credit the materials account, reduce it, and debit the work in process inventory account. So we're actually, with our accounting, we're following the process. Okay. So when the business gets the materials, their journal entry is going to be like materials and then credit cash. Then when we take the materials out of material storage and put it into work in process, we're going to debit work in process and credit materials. Because remember, materials is an inventory asset account, and so is work in process. So all we're doing is moving it from one to the next. Like I said, to me, it helps if I think of it as a physical flow. Someone's actually going over to the materials warehouse, picking it up, and now they're taking it to their workbench. So the materials is going to reduce it from their inventories by crediting it, and I'm going to add it to my inventory by debiting work in process. That's what's happening. Then as I work on it, I'm going to record on in the old days, they would have like, they call it a job cost sheet, and I would just record my labor. So I would do the gluing or whatever my job was, and then record 2 hours at this much per hour, and then move it on to the next department. And then when it finally got finished, they would take that and they would take it to the finished goods. And now we would have all the things that we added on, the materials and the cost of the labor, and we would credit that from work in process to reduce work in process and debit that total amount to finished goods. And we could track exactly how much the job costs, how much materials went into it, how much labor went into it. And then probably before they've closed it out, there'd be some accountant that would apply the overhead to it, right? All right, so I just described it, so let's just walk through it. So when the supplier's invoice is received, it's compared to what's called a receiving report. That's usually where our employee checks it in and makes sure what the supplier says they sent, we actually got, right? And then we do this journal entry. We debit 10,500 to materials, and we credit 10,500 to accounts payable. That's when we receive the materials. Now we have a situation here where the people in work in process are getting $13,000 worth of materials. So they debit work in process, credit materials. Looks like it's 2 different jobs they're working on. One job is 2,000. I don't know why they use the divide sign. That's confusing. And the other's 11,000. So you'll see this is what, like they used to do, like I said, a time ticket where the employee's name is on it. And then they list, I put 4 hours into it at this hourly rate, and I put another 2 hours into it. So this total cost added to the job was $60. And then for job number 72, this employee put money into it. Okay. Now a lot of that's done electronically. Like I said, each employee has like a unique barcode, and they just start working on it, scan their barcode, start working on it, and then when they're done, scan their barcode again, and that just adds the costs to that. But same idea. Okay. And so now this job has whatever time was allotted to it on these different time tickets, plus the cost of the materials. All of that is part of our work in process inventory. So a summary of the time tickets is used as a basis for a journal entry recording direct labor for the month. So here we've got a debit to work in process of 11,000 and a credit to wages payable. Okay. So now figuring out how we apply the overhead to things. This is a little more confusing because to this point it's direct, right? We know how much material we put in and how much time and what our hourly amount for that time is. That's pretty easy. But then to figure out, okay, how much overhead do we apply to a given job? So this says, assume that Legend Guitars incurred $4,600 of overhead during December. which included $500 of indirect materials, $2,000 of indirect labor. So indirect materials is like stuff like glue that you can't measure the amount you do on each guitar, or it could be a lot of things, okay? Indirect labor, again, is like the guy cleaning up the factory. Can't apply that to any one job. $900 utilities, $1,200 factory depreciation. Oh, this tells us that their indirect materials were glue and sandpaper. So here's all their overhead, $4,600. That's the whole kind of definition of what overhead is. I won't read it to you. You can read it because you're intelligent. Just because you're intelligent doesn't mean you'll actually read, though, when I say to read. But there you go. All right, so here's the process by which factory overhead is assigned. Okay, we call it cost allocation. And usually what we have to do is we come up with what's called an activity base. And all activity base means is it's some number that we're choosing to use to allocate the overhead. The most common ones are direct labor hours. So what we're going to say is for each hour of direct labor that's put into something, we're also going to apply a certain amount of overhead to it, or allocate a certain amount of overhead to it. Direct labor cost, for each dollar of direct labor that's put into making this product, we're going to allocate a certain amount of overhead cost to it. Or machine hours. For every hour we run the machine on this project, we're going to allocate a certain amount. And there could be others, but these are common ones. Okay. The idea is we have all these overhead costs, you know, the supervisor's salaries and the glue and the sandpaper that we can't really put on any one job. So how do we estimate how much of it should go to any one given job? And so if our process is very direct labor intensive, we might say, let's divide that up by direct labor. The more direct labor we put into a job, the more of the overhead costs it's going to get allocated to it. So here's another example. I mentioned this before. Here at the college, we have direct labor, which would be like the salaries of the teachers. Okay, we provide a service, so it's a little different, but we're directly related to the revenue source, which is you guys. Okay, but then we have indirect labor. Like there's a guy who keeps this building nice, right? He does a good job. It always looks so nice in here. There's administrators, and there's utilities, and there's all of these different things. And the question is, how do we divide those up? One way we could divide them up is we could say, look, we have $1 million in overhead costs for the whole college, or I don't know, it's more than that. Okay, but let's say we had $1 million. We might say, let's look at each division and see how much their student enrollment is. And then our activity base would be student enrollment in what we call FTSE. That's the numbers of full-time student equivalent. So, and so we would take $1 million, we would divide that by the number of full-time student enrollment for the whole college, and that would give us a dollar of overhead, or an amount of overhead per full-time student enrollment. Then we would look at the business division and say, well, they have this much, you know, they have 100 full-time student enrollment. So we would take that amount per and multiply it by 100, and that would be the amount of overhead that would be allocated for us to be paying for, part of our costs. Okay, maybe instead of saying full-time student enrollment, we might say something like the number of programs they have. So business has business administration, business AAS, computers, and so they would divide it by, they would take the total number of programs the college has, divide that $1 million by those total programs, and then say this division has 7 programs, so 7 times that amount. That's all it means. We're just finding out, we're just making some way of allocating these costs that we don't have any direct way of measuring to spread them across the organization, okay? And so, like I said, the most common is direct labor hours. To say the more labor intensive a project is, the more of that overhead we're going to charge to it as a cost. Okay, so this company, factory costs are normally allocated or applied at jobs using what's called a predetermined factory overhead rate. This is important, predetermined factory overhead rate. Here's how we compute it. The estimated total factory overhead costs divided by the estimated activity base. Okay, so again, they would say we have, what did they say, 40, Oh, I thought they told us an amount. Okay, you know, we have $50,000 in total overhead for this factory. For all of the activities in this factory, we have 50,000 direct labor hours. So every direct labor hour is going to be allocated $1 of overhead or something like that. Okay. So here's our example. Okay, Legend Guitars has a total factory overhead cost of $50,000 for the year. The activity base that they expect for the year is 10,000 direct labor hours. So for every direct labor hour a job has, we're going to apply $5 in overhead costs. So now each job will have applied to it the direct materials, the cost of materials that went into the job, the direct labor, the cost of the labor that went into the job, and overhead, which will be assessed to the job at $5 per direct labor hour. Okay, that's the process. So again, I don't know if I like these where it shows, all they're doing is showing you, they go to the time tickets, they see how many direct labor hours. There was 350 hours on job number 71. Multiply that by $5 per direct labor hour, and that's how much factory overhead. So this job had direct materials of 2,000, direct labor of 3,500, and factory overhead of 1,750. Plus it had already a beginning balance. So it had a total job cost of $10,250. Job 72 had 500 hours at $5. So they're gonna apply overhead of $2,500. Okay. Just remember that in job order costing, there always will be direct labor costs, direct materials costs, direct labor costs, and overhead costs. Direct materials and direct labor are easy because we can measure those exactly. And then overhead's easy once we know the basis for it, because then all we're doing is applying that based on whatever. This one uses direct labor hours, but other ones use different ways to apply it. Okay. So this is just showing, again, the same idea. So there's the journal entry. We debit work in process. Again, increasing that asset, and we credit factory overhead. Recognize that the factory overhead account is increased or debited when we have actual overhead costs. Remember earlier in this, we showed where they recorded all of the overhead costs, the costs of management salaries and the costs of sandpaper and all of that. That gets debited to this account. And then we credit it whenever we apply that overhead to jobs. And then the difference between the two is that we're going to either over apply or under apply our overhead. Because remember, we're using this predetermined overhead rate. At the beginning of the year, we said we think we're going to have 10,000 hours, and we think that we're going to have $50,000 in costs, total estimates. So then throughout the year, what we're doing is recording the actual on the debit side, and when we apply it on the credit side, and at the end of the year, we're going to come up with either an over applied amount or an under applied amount. And probably we'll use any over applied or over applied to adjust our estimating for the next year, right? To be like, okay, we were a little off on it this year. That's normal. So that's what I just explained. A debit balance will be called under applied factory overhead, and a credit, and I should say a credit balance is over applied factory overhead. Too much words, just show us. All right, so at the end of the year, we have to close out this factory overhead to cost of goods sold. We don't want to carry any, because so our factory overhead is this, we're applying it based on an estimate. So we don't want to carry that estimate forward into the next accounting period. So when we get to the end of the year, we are going to make an adjusting entry in essence. Okay. So if our factory overhead has a credit balance, sorry, this is if it has a debit balance, then we're going to credit the account that amount. and debit or increase our cost of goods sold expense. If we get to the end of the year and factory overhead has a credit balance, then we're going to debit the account that much and credit cost of goods sold. That's all, okay? After you do it once or twice, you'll see it's pretty doable. It's not too hard. So here's the journal entry for Legend Guitars. They ended the year with a credit balance, or sorry, a debit balance and factory overhead of 150. So they were underapplied. So they adjusted that by crediting factory overhead 150 and debiting cost of goods sold. So they had a little bit more expense than their estimate led them to believe at the end of the year, $150 extra cost of goods sold expense. If it had gone the other way, they would have actually reduced their expenses a little bit. So just remember, when we do work in process, it's going to include direct materials cost, direct labor cost, and any applied factory overhead. The overhead is going to be the most confusing part of this chapter because it's new, right? The other stuff is, it's new too, but it's more common sense. You can see at the end of the period, we have the total job cost. And the balance coming forward, work in process, plus direct materials added, direct labor added, factory overhead applied, gives us a total job cost. And you can see that adds to our work in process. Actually, this is when we move it out, I guess. So this job got done now, and they're going to move it from work in process out to finished goods inventory. So what we're going to do is we're going to credit the account, the total cost of the job we're moving out, and the new balance of the account will just be the job that's still sitting there in work in process, still being worked on. Okay, so it's really like all that's happening is we're moving stuff from materials. So we're moving stuff into materials as the company buys it. Then we're moving it out of materials into work in process as we work on it, and then adding the cost of our labor to it, and then applying our overhead to it, and then figuring out the total cost of that job and moving that total cost out to finished goods. And by moving it out, I mean we're crediting work in process and debiting finished goods. Remember, these are all asset accounts. So we increase them with a debit and decrease them with a credit. So during December, job 71 was completed. The total divided by the number of units produced can give us a cost per unit. So if there were 20 Jazz Series guitars in job 71, and the total cost was $10,250, then our cost per guitar was $512.50. That's pretty high. This must be nice guitars, right? So I don't know what they're selling them for, but hopefully they're selling them for $1,000 or something, so they're making decent money. But again, the number of businesses I work with who don't know that, who don't know, and again, that's an average, right? Because we just divided out the total cost by the number of units. But the number of businesses who don't know that each of those units cost them $512.50 is staggering. They just don't know. They're just sort of doing their work, selling them for what they've always sold them for. And sometimes they don't realize that their costs have crept up, and they're thinking they're still making good money, but they're making kind of less and less as their costs increase. So it's really important for them to keep track so they know. So again, when they complete that, they debit finished goods and credit work in process. All right, in December, Legend Guitars sold them for $850 each, generating total sales of $34,000. The cost per guitar sold was $500. So I guess these are ones they produced earlier that came out a little less. So here's how they would enter this entry. You remember when we sell stuff that there's always these two different entries. For one is to show how much money we got for it. So our accounts receivable, money owed to us, goes up by $34,000, and our sales revenue goes up by $34,000. That's the $850 that we sold them for times 40 each. The second entry is our cost entry, which shows our expense, cost of goods sold, increasing by $20,000. and then our finished goods inventory going down by that same amount, 20,000. So what was their gross profit on that sale, on that transaction? 14,000, right? Which is the sales minus the cost of goods sold. That's the gross profit. Now, when they start adding in all their periodic expenses, they can find out if they actually made a profit or not, right? So our period costs are costs that are used for generating revenue during the current period. They're not involved in the manufacturing process, and we just record them as an expense during the current time period. Usually that's selling expenses and administrative expenses. So remember, even the manufacturing plant supervisor's salary, we're going to consider that part of our overhead. So it's going to be a manufacturing cost. So we're not talking about that. Okay, that person's salary is not a period expense. That's included in the cost of making the product. Anything to do with the manufacturing process. We're talking about now the cost of selling the product, or the cost of administrating the non-manufacturing processes of the company. There's probably a secretary that works for the sales department. There's probably a CEO of the company who didn't really help with manufacturing at all. Those costs are going to get lumped into the administrative expenses. So selling expenses, it's usually like either salaries we're paying to salespeople or their commissions if they make commissions. Administrative expenses. So they had sales for salaries expense, or sales salaries expense, office salaries expense. So that was $3,500 in period costs. So here's what their income statement will look like. They had $34,000 in sales, $20,150 in cost of goods sold. You might be thinking, wait, I thought it was only $20,000 in cost of goods sold, but it was the $20,000 from the stuff they actually sold, plus the $150 in under applied manufacturing overhead that we applied to cost of goods sold. Okay, so $20,150, giving them a gross profit of $13,850. Then they have their selling and administrative expenses of $3,500. So their net operating income for the period, the month of December, was $10,350. So what you're going to find as you go through this chapter is there's portions of it that you're like, this is exactly like stuff we've done before, but there's other stuff where you're like, this is a little different. And the thing that's mainly different is this flow from the materials inventory to the work in process inventory to the finished goods inventory, and that applying of the manufacturing overhead. Like that's the different stuff. Okay. But that's it for this chapter. So on Wednesday, we will do a guided problem. Okay. And we'll kind of go through one of these together. And then on Friday will be a day to work on the chapter 16 homework. All right. Piece of cake. Have a great day. Be kind. And whatever else. I don't know. Just be kind and you'll be all right.